Good day fellow traders and value investors, and welcome back to another video. The goal of the channel is to analyze stocks as a non-professional and share my findings with you. I also want to make informed decisions when buying a stock in my speculative portfolio and hopefully find stocks that can be added into my value investing portfolio. In today's video we'll look at Lennar. Right now, Lennar chart looks weak. Price just broke key levels and a lot of investors are getting nervous. But for a value investor, the lower the price, the more attractive the business is, provided there's nothing structurally wrong with the business right now. In this video, I'm going to break Lennar down using a full 3-year scenario model, bear, base and bull, using real numbers, real assumption and disciplined technical confirmation to see what's actually priced in today. By the end, you'll know exactly where this stock could go, what needs to happen to get there, and whether this is an opportunity or a trap. Let's get into it. Lennar is one of the largest home builders in the United States. The company builds and sells houses across many states, primarily targeting first-time buyers, move-up buyers, people upgrading homes, active adults and retirement buyers. Lennar operates through several main business segments. First is home building. This is the core of their business. It brings most of the revenue. And this is the single-family homes and townhomes. They also have a financial services arm, which is actually really important. They provide mortgages, title services, closing services. So they're not just selling you a house, they're helping you finance it too. That gives them more control over the entire transaction and can smooth out the buying process. Then on top of that they have multifamily Lennar Other. They are smaller, but they add another layer to the business. A major strategic shift in the recent years has been Lennar's land-light strategy. Instead of owning large amounts of land, the company increasingly controls land through options and partnerships. The goal is to reduce risk during housing downturns. Now that we understand how Lennar actually makes money, let's move into the numbers and see what the market is pricing in. Recently margins have been declining due to buyer incentives, mortgage rate buy-downs, lower home prices and construction cost pressure. The average selling price has been falling recently due to affordability pressure. In 2023 the average price was $445 and dropped to $391 in 2025. And then in early 2026 the average price dropped to $374,000. Lower prices help maintain demand, but they also affect the earnings. In terms of shareholder returns, Lennar returned $3.2 billion to the investors through dividends, share repurchases and non-cash repurchase through the Millrose exchange offer. So now look at the financials in the trading view. First thing to note is that the revenue quarter over quarter has been going down over the last 4 quarters. 4%, 6%, 6%. We'll change to the annual and we can see the same picture of the last year. 2025 revenue down 3.79%. One thing that's quite worrying as well is that the costs are continuously going up. We can see how revenue has been growing over the last few years and then costs have been growing with it, but revenue has plateaued so far whilst the costs continue to be high. We'll scroll down to the net income. We can see a worrying picture as well. Whilst revenue was down 4%, we can see that the net income was down 47%, almost 50%. And the trend continues in 2026 with net income going down. Same for the EPS. We can see how EPS have been going down steadily since the peak of the housing market in the last 5-6 years. Over to the balance sheet, we can see that they have a pretty good debt position. They've been taking a little bit more debt in the last few years. Long-term debt is currently at $4 billion, but the management looked well after the debt. We can see that it's been decreasing and then now is back onto the uptrend. Net debt turned positive as well, which means that they have more debt than cash on hand. And if we quickly expand the cash on short-term investment currently going down from a peak of $6.56 billion to $3.8 billion. And changing over to the statistic, switching to annual straight away, we can see Lennar is currently selling for a PE of 13, cheaper than in 2025. Scrolling to the margin, we can see a downtrend in the margins as well. In the gross margin, the gross margin has been going down from 27% to a low of 15% that's currently seen on 2026. Likewise for net margin has been going down and it dropped about 50% over the last couple of years from 6% to a 3.47%. And finally, current ratio, pretty healthy current ratio of 4.77. It means they have $4.77 of current assets for every $1 of current liability. And then debt to equity ratio pretty low as well, which means that debt is manageable, 0.19 at the moment, down from 0.28 in 2025. So Lennar remains a financially healthy company navigating a more difficult housing environment. Revenue has remained stable, but margins are declining as the company uses incentives to maintain sales. Over to the intrinsic value, we'll first look at the three calculators: Warren Buffett, Phil Town and Peter Lynch's calculators. Warren Buffett's method is using the historical book value per share growth, and using this method we get an intrinsic value for Lennar of $202.40. Phil Town's method is using the forward-looking EPS growth. I use a 9% EPS growth for the next 10 years, and using this method we get a price of $38.38 for Lennar at this moment. And then Peter Lynch's method is using forward price to earnings growth, and I use 9% for the PE growth as well. And we get a rating of overvalued using this method. So using the three methods, we get a pretty wide range for Lennar right now, between $38.38 and $202. And for the 3 case scenarios, I use mortgage rates as the key driver, because lower rates would result in more buyers, which will drive higher prices and better margins. And then in terms of the PE of 9 is near down cycle valuation range, PE of 12 is historical mid-cycle average, and the PE of 14 is boom level, would be between 6 and 18. So in a bear case scenario, with EPS going down at 3%, mortgage rates stay high, incentives stay elevated, margins remain compressed, we could see EPS of 7.28 in 3 years, and the stock could be valued at 65.55 in 3 years. In a base case scenario, with EPS growing at 6%, mortgage rates stabilize, incentive reduced slightly, margins partially recover, we could see EPS of 9.50 in 3 years, and the stock could be selling for 114.05. And in a bull case scenario, with EPS growing at 13%, mortgage rates decline meaningfully, incentives fall sharply, margin expand back towards cycle highs, you could see EPS of 11.51, and the stock could be selling for 161.20 in 3 years. Putting it all through a probability weighted table, you would get a total return of 24% over the next 3 years from Lennar if we buy it at current prices, making it 740 annually plus 214 dividends. That's a total return of 9.54 annually. With intrinsic value on the table, let's now turn to the risk factors. And the first risk is housing market risk. If mortgage rates stay high, fewer buyers qualify, demand falls, home builders must discount prices. This is the largest risk for Lennar. Then there is land strategy risk. The land-light strategy reduces some risk, but introduces others. Reliance on land banks, large option deposits, partnership structures. If land partners change terms, Lennar's cost could increase. Then there is construction cost inflation. Key costs include labor, lumber, materials, land development. If this rises faster than home prices, margins fall. Then there is the economic downturn. Home builders historically suffer heavily during recession. During the 2008 housing crisis, many builders collapsed. Lennar survived, but stock volatility was extreme. And on this point, one interesting thing that I noticed is the stock price has gone up in the build up to 2008. It found a peak, it then collapsed from there. When it looked like a fake out, it found some support in there, it came back up, and then it came down with some momentum, only to find the bottom at about $8 per share. Something similar on the chart that we can see in the recent, and we'll turn to that in a bit. And finally, there is margin compression. Because Lennar uses incentives to maintain sales, profit margin may decline. So when you step back and look at all this, you realize something important. This is not a simple growth story. This is a cycle-driven business. And then final element on the risk is the risk-adjusted score. I gave Lennar the base score of 3. The current ratio is above 1.5, so I deduced 0.25 from the base score. Debt to equity is below 0.5, so I deduced another 0.25 with a total risk score of 2.5. With the total risk taken into account, we get a risk-adjusted score for Lennar of 4.77%, which means we can get a 4.77% over the next 3 years. So with the risks covered, let's now put the risk reward on the chart based on our scenarios. Over to the charts, let's quickly have a look at the 2008 period, how the stock performed then. We can see that it's gone through a boom period, it then found the top, it crashed from there once, it found support in here, it moved up a little, but then it crashed with momentum all the way down to $5 per share or whatever it is in here. If we reset the chart today, I'll just zoom out a little bit so we can see it a little bit better. We can see how the stock has been going up for a few years. It peaked at about $184 per share. It went down once, it found support in here and moved a little bit up, and now we can see that it came down back again. And if we zoom in for the last period, we can see that it's moved with quite a bit of momentum downwards. The last 5 candles, it moved down, there was a gap in here, it's a big candle in here, another big candle, and it pierced through this $100 per share zone. So to me it looks like strong momentum downwards to continue, and provided the earnings were negative, the costs were still up, and with the geopolitical situation right now, it's possible that the stock will continue downwards. Just to zoom back in and discuss a few of the elements or a few things that are happening, we can see that the moving averages are currently in the red, they are sloping downwards. ATR dots are above the price candles, indicating downwards momentum. The Alex Piroglu MACD is currently negative, the MACD is below the minus 50%, indicating strong downwards momentum. We can see it in here. So at the moment all signals are pointing towards some more downwards movement for the price. It is possible the stock will find some support at this $65 per share, which coincides with our bear case scenario. Then just to move it a little bit out of the way, and if we were to buy the stock at the current level, according to our bear and bull case scenario, if we'll use the stop loss, the bear case, which is $65.55, and for the profit level, if we use the bull case scenario, $161.20 per share, we get a risk reward of 2.50 at the moment if we buy it and hold it for 3 years. So let's bring everything together, fundamentals, scenarios and the chart, and answer the only question that matters. Is Lennar a buy right now? If we take the base case scenario and compare it to today's prices, you're looking at roughly 20-25% upside. That's a moderate margin of safety, not a huge one, which means this is not a screaming bargain, but it's also not overpriced. The upside depends heavily on a strong housing recovery. Simple as that. If you enjoyed this analysis and found it useful, hit the like button, consider subscribing, and let me know in the comments what stock you'd like me to analyze next on Fundamentals in Motion. Thanks for watching.